You paid your insurance premiums every single month. You drove carefully. You followed the rules. So when your car was finally hit and you filed your claim, you believed the system would protect you, but instead your phone rang. A letter arrived, and suddenly your case was denied. No payout, no repair, no explanation you could understand. Just one cold legal sentence buried in the fine print erased everything you thought you were covered for. Every year, millions of drivers around the world experience this exact moment, trusting their insurance until the day they need it the most. And discovering the coverage they paid for might never have existed the way they imagined. Car insurance is marketed as a shield, a financial safety net that activates in your worst moments. Commercials show smiling agents and reassured drivers walking calmly away from wrecked vehicles, protected by reliable coverage and promises kept. But behind those glossy ads is a far darker reality. Claim denials are far more common than anyone admits, and most drivers never discover why their money didn't protect them, because insurance policies are written not for the everyday customer to understand, but for lawyers, auditors, and claim adjustment departments trained to find legal exit routes that allow companies to pay as little as possible. The truth is simple but brutal. Insurance companies make profit not by paying claims, but by denying or minimizing them. Today on Fine Print Files, we expose the real reasons your car insurance claim might get rejected, reasons hidden deep inside confusing legal language, outdated rules, missing documentation, technical exclusions, and human bias, all packaged under one chilling phrase: not covered under your policy. Most car insurance denials begin not at the accident scene, not at the body shop, and not even during the claim call. They begin the moment you signed your policy contract. That 30-page document full of dense language and microscopic clauses quietly outlined exactly how your claim could fail before you ever crashed your car. The most common denial occurs because drivers don't actually carry the coverage they believe they purchased. Many people assume they have full coverage, a marketing phrase that technically means nothing in insurance law. There is no legal definition of full coverage. Instead, policies are built from separate components: liability, collision, comprehensive uninsured motorist protection, and medical coverage, each chosen individually. Thousands of drivers discover too late that their policy covers only liability, meaning it pays for damage to other vehicles, but not their own car, leaving them financially responsible after the accident. Another denial often stems from deductible misunderstanding. Even drivers with collision coverage frequently underestimate their financial responsibility. A deductible is the portion of your claim that you must pay before insurance contributes anything at all. For example, if your repair costs $2,000 and your deductible is $1,500, the insurance payout will only equal $500. When damage estimates fall below deductibles entirely, insurers pay absolutely nothing. From the policyholder's emotional viewpoint, the claim feels denied, even though technically it was rejected on numerical grounds rather than legal ones. These deductibles are intentionally structured to discourage smaller claims and lower insurer payouts, shifting financial burden to the driver while still fulfilling contractual language. Fault determination is another powerful tool used by insurers to deny or reduce claims. Insurance companies employ internal adjusters who analyze accident scenes, vehicle damage patterns, and police reports to decide fault percentages. In contested collisions, the insurer may declare partial or even full fault on the policyholder regardless of witness testimony. Since most states follow comparative negligence laws, fault percentages translate directly to payment reductions or total claim denials. If your insurer establishes that you are more than 50% at fault, some states allow payouts to fall to zero, leaving drivers fully unprotected even when other vehicles contributed to the crash. Timing is equally critical and often overlooked. Insurance policies require prompt claim reporting. A delay of days or weeks before notifying the insurer may permit claim denial on technical procedural grounds. Companies justify these denials under the premise that investigating older incidents becomes unreliable. Unfortunately, accident victims who prioritize medical care or vehicle safety over paperwork sometimes inadvertently sabotage their claims, simply by waiting too long to call. One of the most severe reasons claims get denied comes down to misrepresentation. Information the insurer claims you provided incorrectly when purchasing coverage. This includes inaccurate mileage estimations, incorrect garaging locations, misreported driving history, or underreported vehicle modifications. Insurers run automated data checks using national claim databases and DMV records. If any discrepancy surfaces after an accident, insurers may retroactively cancel policies or deny claims based on alleged fraudulent underwriting. The driver might not have intentionally lied. Many simply guessed incorrectly, but intent rarely matters in insurance law when profit protection is at stake. Excluded driver clauses represent another silent killer of claims. Many policies allow families to formally exclude drivers, often teenage children or household members with previous violations, to lower premium costs. If an excluded driver is behind the wheel during an accident, even with permission, the entire claim may be voided instantly, leaving owners with no compensation at all. What makes this so devastating is that many households forget exclusions even exist until the paperwork arrives after a crash. Uninsured or underinsured motorists pose additional complications. Although many drivers believe their uninsured motorist coverage protects them robustly, claim applicability depends heavily on documentation and cross-insurer negotiations. If the at-fault driver flees the scene without clear identification, insurers may refuse to honor the claim due to lack of proof that the other party was uninsured. Hit-and-run accidents become legal battlefield scenarios where technical uncertainty erases compensation promised in advertisements. Vehicle usage exclusions also trap countless claimants. Policies explicitly require drivers to declare vehicle purpose, personal, business, rideshare, or commercial delivery. Drivers working for food delivery apps or rideshare platforms often unknowingly violate these terms. The moment insurers identify business usage on personal auto policies, claims can be denied immediately. The explosion of gig economy jobs has dramatically increased this type of denial, catching millions of unsuspecting drivers who were never warned about invalidation risks. Mechanical failure and maintenance exclusions create another denial pipeline. Insurance covers collisions, not neglect or wear and tear. If investigators determine that faulty brakes or tire blowouts from poor maintenance caused the accident, companies classify claims as owner negligence rather than insured events. These determinations remain heavily subjective and guided by corporate financial interests, placing the burden of mechanical blame on drivers whenever feasible to avoid payouts. Finally, insufficient documentation destroys a shocking number of claims. Missing police reports, incomplete medical records, clear accident photography, absent witness statements, any missing evidence empowers insurers to say, there is insufficient proof to verify loss. The burden rests with policyholders to document every detail meticulously, yet most drivers do not know this until it is too late. The complex administrative burden often favors insurance companies by default. The better prepared party typically wins. Beyond these formal denial mechanisms, there exists a hidden layer of aggressive claim management strategies. Insurance companies operate internal claim reduction algorithms that flag payouts exceeding profit thresholds for increased scrutiny. These flagged cases undergo repeat document requests, excessive follow-up investigations, and negotiation roadblocks designed to psychologically exhaust claimants into abandoning claims or accepting minimal settlements. Most people settle simply to end the emotional torture. What emerges from all these practices is a grim system. Insurance does not operate solely as consumer protection. It functions as a profit maximization engine designed to carefully decide when to pay and when to legally escape payment. Policies are written not for clarity but for elasticity, allowing clauses to stretch or contract to favor insurer outcomes depending on circumstances. Drivers walk into insurance agreements believing they are purchasing peace of mind. In reality, they purchase a legal gamble, one in which understanding the rules matters more than paying premiums faithfully. When your car insurance claim gets denied, it feels personal, as if the system targeted you specifically. But the painful truth is that nothing unusual happened. Simply encountered the reality that millions of drivers experience every year. Insurance works beautifully until you actually need it. Only then do the fine print traps snap tight. The denial letter ISNT, proof of individual failure. It's proof of how profit-driven protection systems operate by design. Understanding these tactics is the first step to self-defense. Before you believe coverage claims, Read the fine print slowly. Verify vehicle usage rules. Confirm every driver listed on your policy. Photograph accidents relentlessly. File reports immediately. Never assume coverage. Demand confirmation in writing. Because insurance exists not to protect the careless, but to legally pay as little as possible to those who trust it blindly. This is Fine Print Files, where we reveal the rules hidden between the lines, so you never learn the truth only after it's too late.